Welcome to the North Forge Discovery Series, everyone. My name is Tina Lee, and I'm the Marketing and Events Specialist here at North Forge. For today's webinar, we'll be learning about stock option plans and their benefits for startup companies. Before we begin this webinar, we acknowledge that we are meeting virtually on the ancestral land of Treaty 1 territory, the traditional gathering place of the Anishinaabe, Cree, Oji-Cree, Dakota, and Dene people, and the homeland of the Red River Métis people. For those of you who are new to our webinars, North Forge is a not-for-profit organization and the innovation partner for the province of Manitoba. We are a business incubator accelerator supporting the growth of Canadian science-based, technology-enabled, and advanced manufacturing startups from the ideation stage all the way through to Series A. We fuel Manitoba's innovation economy by providing entrepreneurs with industry-leading mentors, award-winning growth coaches, and rockstar subject matter experts in our 4-stage Founders Program. North Forge also has the largest nonprofit, publicly accessible fabrication lab located in Winnipeg's Exchange District. The Fab Lab has in excess of $3 million of advanced manufacturing equipment that has helped more than 3,000 members develop over 7,500 prototypes since 2011. The North Forge Discovery Series are free events that we host in conjunction with and promotion of our Founders Program. If you have a business idea and would like to find out more about our Founders Program, please visit our website or send me a note and I'll get in touch with you and our programming team. I'll place my contact information into the chat shortly. And with that, I welcome Leo Palay, who is a lawyer with TDS Law. He works closely with both established private businesses and startup businesses in order to maximize tax-efficient growth while protecting the interest of the founders every step of the way. When the time is right for the client, Leo provides pragmatic and effective advice on the sale of their business, bearing in mind both tax and business considerations. Leo is known for his aptitude for detailed research, pragmatism, and understanding of complex tax situations. He has worked with small business owners and delivered presentations on corporate and tax law to them to help them better understand the tax planning tools that Canadian businesses and their shareholders have available, as well as how to avoid the common pitfalls that can result in significant tax costs, sorry. He also lectures at the University of Manitoba Law School on corporate taxation for 2nd and 3rd year law students. Leo is an active volunteer in his community and enjoys applying his knowledge of corporate and tax law to help charitable organizations continue their selfless work that impacts communities across Manitoba. And now, Leo, the floor is all yours.
Thank you very much. I'm just going to share my screen and I'm just going to ask you to confirm that it's worked.
Looks great, Leo.
Okay, and you can see it move?
You betcha.
Great. Okay, so hello everyone. I'm happy that a few of you are here to see this because it's a very popular and trendy thing over the past 10 years or so, and it's very unique and it's not necessarily very intuitive. So it's important to learn about, especially in the startup sector, which I'll touch on in a few minutes. Feel free to interrupt me whenever. If you have a question, you can throw it in the chat and I'll either answer it, or if I think I'm going to answer it in a minute or so in a slide, then I'll just hold off a little bit. The first thing is, what are stock options? So stock options generally, and I'm not speaking necessarily legally here, but I'm saying generally when someone's referring to a stock option, it's basically an option or a right which can be exercised by a person to purchase or be issued shares in the capital stock of a corporation. It's nothing more than that, but there are a lot of variables, right? There's a lot of variables about what the issue price is, what the fair market value of at the time is, what kinds of shares are being purchased, stuff like that. There's usually a triggering period. So there's either a triggering event. Commonly in startups, it's something like you get 10% of your stock option every year, and then on year 3 you get to purchase all of it or something, which is called a vesting period. You might hear someone say a vesting period. You might hear someone say vesting with a cliff, being you get all of your options after 3 years. That's what people refer to as a cliff. There's lots of language people use, and none of it's really based in Canadian law or Canadian, corporate legislation, but it comes from the big U.S. companies and the U.S. TV shows, honestly, saying vesting with a cliff, and lots of people read about that sort of thing. So these are options to purchase shares of a corporation. They can be vesting immediately. You can buy them either right away, or sometimes there's built into the terms of the stock option agreement. There's you have to work for 3 years before you can purchase shares. The other main variable is the price. So sometimes there's no fixed price. It's just whatever the fair market value of the shares are, as determined by either the accountant of the corporation or depending on what kind of shares they are, by an offer or whatever the most recent valuation dictates. So sometimes if there's a company who let's say a triggering event is whenever they're offered by a third-party corporation to purchase their shares, that's a triggering event, and then they can buy the shares for fair market value prior to then. Sometimes they work for 3 years, and then you can buy shares at whatever the fair market value is. Sometimes they can be issued essentially for free or for a nominal amount. A nominal amount, and for or they can be a higher amount, and we're going to talk about what the tax implications of that are. But for startups, it's typical for this to be a nominal purchase price. Basically saying, I'm giving you these shares as long as you work and do your job for 3 years, or for 2 years, or for 6 months, or whatever it is. You get X amount of shares of the company. It can be percentage based, and it can either be percentage based, or it can be something as simple as $1, one share, 20 shares, so that's really what the price could be. But there is lots of wiggle room there. So there's a question here in the chat from Dana. For fair market value of share prices, is there a Canadian equivalent of a 409A valuation? Not to my knowledge. There might be, but to my knowledge, and at least in this circumstance, it's whatever the fair market value is. Usually, if people are trying to really lean on a valuation, they would get someone who's called a chartered business valuator, so a CBV, you'll hear them be called, to do the valuation. That's hard for the CRA or for anyone really to challenge to some extent. They usually give a range, though, so sometimes people say, okay, well, I'll buy the shares for the high range and not for the low range, so there's still some wiggle room. But if you're really trying to lean on a valuation, then that's what a CBV is what I would recommend looking at. Most accounting firms, the large ones anyway, will have CBVs who are also chartered professional accountants, but then they get an additional set of letters because I guess 3 isn't enough. So they want so there'll be CPA, CBV, and anyone at the larger accounting firms will be able to connect you with one. There's also some other valuators who are also business brokers, and they do also types of valuations, which are again difficult for the CRA to challenge. Hopefully that answers your question. Feel free to clarify if I didn't.
Yeah, thank you. Just one more thing on top of that. Like, do you
Sure.
think the 409A valuations that are being done by these sort of US valuators, and it's more of a US entity type of thing, would that be something that the CRA might consider as like a fair market value for the options in Canada?
So the way the CRA's valuation works is basically you value your own shares, and it's a self-reporting system. So they will say, if they think your valuation is wrong, they have to challenge it with their own valuation department. They have a hard time challenging someone who's certified, anyone who's certified, even if they're not Canadian, in evaluating a business at the time, because they're usually looking 3 years back. Sometimes that colors their valuation, and particularly with high growth businesses like startups. Obviously, if you're saying your shares are worth nominal amounts, let's say you just start your business, your shares are worth $1, and then 2 months later you have an idea, then you've developed it, and then the shares are worth $2 million. The CRA might say, well, hold on a second, those shares are never worth $1. That's not something they would likely say, just because it's easy to show that it was when it started. But that's an example of, it goes quick. If your valuation changes quickly and you're doing any sort of tax driven transactions, or any transaction that relies on a fair market value being accurate, it's important to have a reasonable valuation by someone who's either the accountant of the corporation, or even better, a CBV. Lots of transactions, especially if you're getting one done by a tax lawyer, will have what's called a price adjustment clause. Those will, and when there's shares to be issued, those actually adjust your share value in accordance with whatever the CRA determines it to be. So for business purposes, that's difficult to fathom, but for tax purposes, you're just trying to make sure that whatever your future transaction is, there's a fair market value that you're using. And instead of you getting a capital gain or a capital loss, for example, the price will just be adjusted, and then the shares will be adjusted accordingly when they're sold again. So that would be the cost base of the shares, or the acquisition price of the shares. That's probably a lot of information quickly, but I didn't want to veer too much off of the topic here, being stock options. But for basing your stock options valuation, it's what I would say is it's got to at least be reasonable. And the business considerations, generally speaking, if two arm's length people, so people are unrelated essentially, agree on a fair market value, that's what it is, and the CRA can't really do anything about it. They can try, but if you're going to court and the judge says here are two people who are bargaining against each other keenly and they arrive at this price, who's the CRA to say that that's wrong? They're not market experts or anything. So that's what a brief answer about how fair market value works, at least in the context of tax. So why do people love stock options? So generally speaking, the primary two reasons I would say are that it doesn't immediately or directly impact the cash flow of the business like a salary or a dividend would, and which is very helpful for the business. Even though a salary, you get a deduction in the business, it's a cash flow question, and lots of startups are starved for cash, right? So they are going to want to say, instead of paying you a salary of $100,000 a year, I'm giving you stock which is worth $100,000 a year, and I don't actually have to pay you any money. You just get the value of the growth of the business, provided that it means that the company actually has to reach that value. Which brings into the second part of this, is that it actually encourages people to promote the corporation or grow the corporation. The expression is to have skin in the game. So they now their remuneration or their pay is now fluctuates with however the business performs, right? So they're going to be incentivized to have the business grow as much as possible so that they can cash in their shares, when either the company's purchased or when, when they get bought out, or, just to hold the shares, to have something of value, of significant value, where they're getting dividends on those shares, for example. That's a huge thing. So this incentivized, rather than someone paying someone a flat fee. This is more similar to a bonus type structure where you're incentivizing someone to do something. And this is a really good incentivizer, because it's not only incentivizing them to do the thing that they're doing, but to promote the business itself. Stock options encourage the holder to remain in the business until they have their shares at the very least. What lots of companies do, and whether it's going to catch on or not, is I've seen people have agreements where they can purchase the shares, but if they leave the company within X amount of years, their shares are bought back for $0. So it's kind of we call this reverse vesting option. That gives everyone upfront, here you have your shares and they're yours to lose if you do anything stupid, if you get arrested and you can't work anymore, if you leave the country, if you quit even without finishing your job, if as your manager I think you haven't done your job, then I can still cause the corporation to buy the shares back from you for $0, and then you walk away. So there's lots of flexibility there, and you can really, if you want someone to be there for years, you can say your vesting period is 3 years. If you want someone to be there, for a long time, you basically give them stock options. You get 10% every year. If you want someone to do a job and then leave, you say your stock options vest as soon as you finish your job, your stock options vest, you can purchase the shares, and then you can sit around and not do anything, but you've been paid your shares. For the actual workers, being the employees, or usually it's the employees, or sometimes the contractors, but usually employees of the company, it's much more tax efficient than getting a dividend or a salary, because they're paying immediate tax on it, and there's no deduction to them for it. I'll talk about the tax implications in just a few minutes. There is a program for a corporation to get registered through Manitoba province. It's called the Employee Share Purchase Tax Credit. Basically, they get a tax credit equal to a certain amount to help fund their purchase of a company shares. I haven't, in my experience at all, seen anyone want to do this program, because it's a policy right now of the government if you register for this, you don't get to be registered for the small business venture capital tax credit. They say you can have one or the other, and most investors, most people care more about losing out their investors as opposed to losing out their employees' share purchase tax credits, especially because if their employees are buying their shares, it might even be for a nominal price, so the tax credit doesn't even help. So I'm not going to talk about that very much. If the policy ever changes, you can have both. There might be some planning to do with helping the corporation fundraise, using the government's tax credits. That can be an option, but right now it's really not popular. Stock options are, as I discussed already, sort of, you have your cash strapped. You want growth. That's basically what you want. You don't necessarily need profitability as much as you want value. You want value. You want dedicated workers who have skin in the game. These are really popular for startups for those reasons. I'm going to talk not too much, but I want to give a brief overview of how it works for tax purposes. I don't want to overload anyone with information here. And if you're going to take one thing away, just to understand that for most startups, it is more tax efficient to issue a stock option or to issue shares in payment for work as opposed to a salary for the worker. It is, from a business perspective, very, I don't suggest startups issue shares willy-nilly, without thinking too much about what they're going to, I'm using an example of a company I advised, and they started off being worth, maybe nothing, obviously, and then, maybe they grew to $100,000 valuation over a course of a year, and now maybe they're worth, 2 million, 3 million plus dollars for all of their shares, and they were going to issue shares to someone to do some programming work for them, and they decided finally, and I advised them specifically to be careful. I said, it's a great thing to do, you're strapped for cash, but it is really, do you really want to do this? It's something that you really need to think about. And it's really, if you don't have the cash to do it and it's your only option, that's what you got to do. But so what they did is they said, no, okay, we're not going to do it. We're going to just fundraise and use this part of, maybe fundraising at first will be harder, but then at the end of the day, when we cash out, 5% of $100,000 is not a lot, but 5% of $3 million is a ton, right? So that's why it's easy to think, oh, I'll throw you shares, it's worthless. If I make it big, it's great. Who cares? I'm not going to care about 3%, 4%, but you will when we're talking these kinds of numbers, especially in the startup sector. That being said, it is important to remember that stock options are good for the employee, and they're really much more tax efficient for them. So how it works is, if there's an agreement to issue shares, including an option agreement, to an employee, there is a taxable benefit to that employee equal to the fair market value of the difference between the amount paid for the shares and the fair market value of the shares. So what this means in plain English is, notwithstanding anything else in the Income Tax Act, if you issue shares for that are worth, say, $1,000 to someone, let's make it more interesting and say $10,000 to someone, and you're issuing to them for free, they're going to get a taxable benefit basically as if they received a salary for $10,000. And so without any of the other sections of the Act, you're basically looking at the same thing as a salary when you're issuing shares. If they paid $10,000 for those shares, there would be a taxable benefit of zero. So that's why when they're buying shares, if they're buying them for fair market value, likely no tax implications. If they're buying it for less than fair market value, there's going to be a taxable benefit to them, and they're going to have to report on their return essentially as if it's a salary. These are, a taxable benefit is something that the corporation bestows on someone of value, something of value. So, sometimes certain benefits are taxable. If the corporation's paying for your haircuts, if it's a sort of a modeling agency and it's paying for your certain things like nails or makeup, not just to do with photo shoots. They're giving you products. They're giving you, vision care, beyond a certain point. Various examples of what's a taxable benefit. But if the company gives a gift, it's usually a taxable benefit. That's a general rule to remember. Now, here's where it becomes attractive, specifically to startup companies and smaller companies. So a Canadian-controlled private corporation, which is a defined term in the Income Tax Act, it means exactly, unlike most things in the Income Tax Act, this means exactly what it says. A company that is well, it sort of means exactly what it says. It's a company that is not controlled by someone who is not Canadian. So as long as it's 50% or more Canadian controlled, and it is not a corporation that's on a designated stock exchange, so public, traded publicly, it is a Canadian controlled private corporation. Doesn't matter how big or small it is. The key here is the amount of taxable benefit is calculated at the time of share issuance. So let's say the shares are being issued at the $10 million, sorry, $10,000 of fair market value. Purchase price is 1 cent. The taxable benefit right there is approximately $10,000. However, they get to defer this tax treatment, and they don't need to record it until they sell those shares. So that's a huge benefit, because it's the risk of them having to report, if they're reporting salary, a taxable benefit, they don't even know if they're going to realize that amount, right? They're going to have a taxable benefit of $10,000, and then maybe the corporation goes under and their shares are worth nothing. So they actually got a taxable benefit and reported that benefit, and then they get some help, and there's some relief provisions if the corporation goes under. But this means that they don't actually have to worry about coming up with $5,000 to pay the tax on that $10,000 benefit. And sometimes it's more, sometimes it's $50,000, and not everyone has $25,000 to pay for a taxable benefit without receiving any payment, right? So that's a really key important thing. They don't need to actually report the tax until they sell the shares, and at that point you're getting proceeds to pay the tax with anyway. A really amazing second aspect of this is the deduction that's available. So basically, in most circumstances where there's a startup company and they've been held for 2 years, usually if let's say your startup company, you use stock options to get your business up and running, you hire a programmer, marketing, etc. You give them 5% each, and then those employees hold the shares for 2 years. When you sell after 5 years, 5 to 7 years, if that's still the typical amount. Last time I took a North Forge presentation, that's what it was. Then they've earned their 50% deduction. What this actually does is it helps them. It treats it more like a capital gain, which is half taxable, as if they were purchasing the shares normally, and it gives them a deduction. So it's very much more favorable than a salary, because you get another 50% deduction. It means the shares have to be held after acquisition. So if you have a stock option and they don't exercise it, one of the considerations for exercising it right away is to start this 2-year clock. Okay, so hopefully that answers this question. The other way you get the deduction is if the issue price is fair market value. So that's not as common in the startup world, but that's another consideration. If the issue price, let's say you purchase the shares for fair market value and they go up, 3 or 4 times what they were, you still get a capital. You would get a capital gain, but you get a actual deduction to the taxable benefit that you receive. So it's helpful to have that available if the issue price is fair market value. But that's not that common, because most of these programmers, marketing people are not, they're not cash flush. They usually don't have $10,000 to just put into the business to buy the shares. So and it also kind of defeats the purpose of it being remuneration, right? If they have to buy them for fair market value. sometimes, when you're an employee, you get salary, you get annual salary, and then you get an option to buy the shares at fair market value. That's where it's more common to have this provision in there, is if you're an employee that's being paid regularly, and then, after 5 years, you get options to purchase stock. That's where the deduction is very helpful. If I'm not mistaken, that is my last slide. So thank you for listening. Hopefully it wasn't too much information quickly. I do want to draw everyone's attention to the disclaimer that, firstly, all of this stuff is general and specific to nothing. There's no set of facts I'm basing this on. It is just very general information. Each person's particular facts can change anything, even if it's not intuitive to you, even if it's not intuitive to me. The Tax Act is very, very specific, and if you don't follow it to the T, it's difficult. And one small fact, one comma in a contract can change the meaning of what the options are. It can change what the issue price is. It can change what the valuation is. If you have other employment income, if you have other, if the corporation doesn't qualify for this treatment, there are lots of other factors in place that someone would need to consider if they're going to give you legal advice. So this is definitely just information, but I'm hoping it was enough information so that stock options are good for the employee because they are tax efficient. They are good for the business because they are they allow you to incentivize your employees to grow the business, and they are not a hindrance to your cash flow. But be careful when you're a growth-based business and you're issuing shares, because it means at the end of the day, when you cash out, you're getting less money, and it can be a substantial difference when you're talking about, even in the tens of thousands or hundreds of thousands in valuation. It turns into a big difference. Let me know if there's any other questions, if anyone has any further questions. Otherwise, I'll pass it back to Tina. Yep.
I had a question.
Matthew?
Yeah, I guess maybe two. That's okay. The first one is do you know of what is fairly common for a startup company that's maybe worth they're just starting out, been in business for a year or so. What is a common amount to give to an employee? I wouldn't want to insult them with 0.0001 of a share, but you don't want to be giving away 5% a year either. So is there
Right.
that you see?
It really depends. It's a business consideration. So it's how badly do you need them to do it? It's just a negotiation, right? It's if you can say I'll give you 1%, that then they might say, okay, well, I won't do it or I will do it. It's the same as a salary in the terms of negotiating. I've seen, I think it's very, very uncommon to go north of 5% for a startup that's fairly new and just sort of getting help through, doing things like programming and sort of typical startup requirements. But I think, between 1% and 5% is common, but it's, again, be very careful. 1% of $100,000 is still some cash, but it's not really a lot. But 1% of $1 million is a whole lot more, right? So it's really, I've seen under 1% too. It really depends on how things are going. I haven't done one of these for a startup in the past probably 3 or 4 years, so I'm not sure what the market is. The last one I did, they were going to give 5%, but they backed out with after being warned about sort of all you have to do is show them the math quickly about this is 5% now, but this is 5%. You have $1 million.
Right.
So it is probably changing frequently, and depending on how easy or hard it is to get the labor you need.
Okay, that makes sense. Thank you. My next question would be, this is probably in the contract, I suppose, but I'm just like as far as the exit for the employee, like let's say if after a few years they have those shares that they're entitled to, in order to actually convert those to cash, they would actually have to sell those shares to somebody else who wants to buy them, right? Or they can't just come to you and say, hey, I would like these in cash now, please, right? Like it's not that simple, or is it?
It depends. It depends on what kind of shares and what's in the contract. So you're right. There are shares that they can be issued that do have that right. It's called there's a redemption or attraction right on shares that they can decide. They can give the corporation notice if they want their shares to be purchased, so that either they force the company to buy out their shares from them, or they or other way around, but they can't force you to buy the shares personally from them. And that's usually what they would want, because it's way better for them if they sell the shares to another person versus the corporation buying their shares from them.
Oh, okay. That's good to know.
And that goes for not even stock options. That goes for all shares. If you're ever getting the shares being purchased by the corporation, you get deemed a dividend, a taxable dividend for the proceeds you get. That's about a 45%, 38 to 45% tax rate. Whereas if you sell it to another person, it's about a 25% tax rate. So it's a 0 to 25% tax rate. So that's why it's always better to do it that way. So yeah, that's I guess the answer to the question is depends. Again, I know these are both it depends questions, but it depends on what you negotiate. Typically, most of the shares that they have are not retractable at their option. That's what I see. They're sold, and usually, if there's going to be more than one shareholder to a corporation, there's a what's called a unanimous shareholders agreement in place.
Yep. And
basically, all savvy investors or sophisticated investors are going to require your company to have one in place anyway. But that's usually governs how and when you can sell the shares, regardless of what the original contract said.
Okay, that makes sense. Thank you.
Yeah, very flexible to whatever the two parties agree. Any other questions?
No, I think that's everything. Thank you so much.
Thank you for having me.
You're welcome. Really appreciate, Leo, that you answered everybody's questions, and that all this information is really good for our startups to know, how they can help their employees best with their stock ownership ideas. So I want to just thank also everybody for being a part of the North Forge Discovery Series. We're looking forward to seeing you at our next events. If you follow us on Eventbrite, you'll be notified about upcoming events. I'll be adding new events soon, and you can follow the link in the chat that I'll put in there shortly. Check your email for today's webinar resources and the recording sometime in the next week or so. And if you have a business idea and would like to find out more about our Founders Program, I'll put my information in the chat, and you can reach out to me, and we'll continue from there. Before we wrap up for the day, we'd like to thank our sponsors, Bell MTS, BitSpace Development, Boxstall Construction, Princess Auto, RBCX, Stu Clark Center for Entrepreneurship at the University of Manitoba, and TDS Law. And that's a wrap. Have a wonderful day, everybody. Take care.
Thanks for your presentation.
Thank you. Have a good day.